Hello again, and welcome to today's webinar hosted by Fridman Law Firm. The topic will be how startup investment works, essential things to be aware of when raising capital. My name is Tamar Katamadze, and I'm a senior associate here at Fridman Law Firm, and I will be moderating the webinar. So I would like to introduce our firm's managing partner, Neil Fridman, who is a prominent New York City tech startup attorney and startup investor, and our phenomenal guest speakers, Joshua Siegel, general partner of Acronym Venture Capital, a New York venture capital fund that invests in late seed and the Series A venture capital financing rounds of software, internet, and tech companies. And Roy Vella, who is the founder and the managing director at Vella Venture. He is known as a solid leader, strong revenue driver, and a keynote speaker. I'm really excited to have you sit down with us today. Thank you for your contribution. For our audience, if you have any questions during the panel discussion, please type them into the question box if your in your Zoom control panel, and we will have time for your questions at the end of the discussion. So before we go further, I would like to give you a brief overview of the topic. In general, raising capital for a startup is an overwhelming and even mysterious project for many entrepreneurs. It's a complex process and occurs in a series of different investments at various stages of a company's life cycle. Startup companies have a lot of financing options available to them, such as friends and family, angel investors, incubators, and accelerators, venture capital firms, crowdfunding, venture debts, etc. It is impossible to discuss raising capital without putting into context the entire startup process. Generally speaking, raising capital is a byproduct of adequately preparing their business and team. For example, angel investors and VCs are in the business of investing in companies that present good business to buy. Ideally, they want companies with a high growth potential and exit strategy. In its simplest form, entrepreneurs' goal of their capital strategy is to reach a set of milestones that attract different investors so they can eventually raise the next round of capital. I would say the best approach towards obtaining investment is on building a great investment opportunity and deciding which investors are best for the company. But I would like to ask more questions regarding the topic, our keynote speakers. My first question would be about raising capital before and after the pandemic. What's different about investor activities pre and post pandemic? Joshua, please.
Sure, so I'll start. So there's really a number of factors at play here, but first and foremost is when COVID really hit in March and people were just figuring out what was happening for March, April, and May, investment stopped. Like a lot of VCs were just stopping to see what was going on. We were taking everyone's temperature. We were worried about our existing portfolio companies. And so things got very, very, very slow because nobody knew what was going on. It was a knee-jerk reaction to essentially, a global crisis as well. Very different thought process that goes in from a recessionary environment, right? Now, however, we are fully open for business. We see what's going on. We are adjusting to it. The world is adjusting to it. And we're like, look, we got to fund companies because we don't fund companies for tomorrow. We fund companies for 2, 3, 4, 5 years out, right? So while now we're meeting companies over Zoom, whereas before we never would have funded a company without meeting the founder. You never give someone money unless you've met them in person or you know them, you have a previous relationship, right? So now we've adjusted. The knee-jerk reaction, the fear has passed. There is plenty, I mean, a lot of dry powder in the venture capital ecosystem. We've got it. We're raising again too as well, but the money is in the bank, as it were. We have to spend it. The thing that is really not understood outside of VCs is when you're given money to invest and you don't invest it, you have to give it back. Nobody wants to do that, right?
Yes.
So you're always finding deals. So there's plenty of money. We are being more careful about what we invest in now. So the amount of money going into deals is definitely coming down. The total amount of money has come down for the year, but there's a lot in, there's larger checks into higher level deals and then checks into lower level deals as well. So that's going to be an issue. But as 2021 opens up, it's all going to start to go back to normal. But it's all going to be done by Zoom. It really is being done by Zoom. We are comfortable getting back on planes, but it's few and far between. If we don't need to meet a founder in person, we don't need to do it. We just don't.
Thank you. What do you think, Ray?
Yeah, no, I agree with all that. I mean, I actually think it's going to probably be good news for startups not in the States. So a lot, I mean, no offense, Joshua, but a lot of VCs I know, fairly lazy, like on the West Coast, don't want to have to go to a board meeting in Europe or Israel.
Well, that's how they invest. That's how they invest, though. That's the problem.
Well, so now, if they don't have to get on a plane to go to a board meeting, okay. If it's just about time zones and it's not about travel and all the hassle, I actually think that will broaden the spectrum of where investments could possibly happen. And also, the due diligence doesn't have to happen live. Like, I mean, there's a whole bunch of elements where, I can tell you, my buddies in the Bay Area, they kind of want to make their tea time, but if they can do their, in their due diligence and their investment remotely and sit on the board remotely, and I mean, the whole world has swung to fully digital. And it has become completely acceptable to both work remotely, but also to do everything else you need to do as we're doing it right now. And where you are physically, a little bit less important. And I completely agree with Joshua. There was a period of four to 8 weeks where it was the deer in headlights. Everyone froze. Like, oh shit, what's happening? I don't understand. And then they have to invest the money. Like the money needs to go out the door. No LP is happy with a firm taking their management cut without actually doing something with it, right? So, investment will definitely continue. No question.
And Roy brings up something very interesting, that a lot of West Coast VCs, traditionally on Sand Hill Road in the Valley, they don't like to invest more than 90 miles or even 50 miles from their office. That's just been part of their mantra for a long time, because they want to know and see and get to know their founders. And the fact that you can do stuff digitally is changing, but I would say that that's less of a fundamental issue than the fact that the founders that were there are leaving the Valley. So the people that they would have invested in are no longer there.
Well, and there's also this.
They are getting out of town.
Yeah, but there's also this this talent ecosystem belief, right? That you got to be in the ecosystem so that all the good talent is here, right? But the idea that now actually the good talent is anywhere, that also diversifies it. They go,
Correct.
What do you think, in which industries are you seeing capital flow? Like, for example, at the beginning of the pandemic, we noticed capital flowing to work from home, heavy industries such as video conferencing, Zoom, or gaming companies, or remote productivity tools. So are you seeing a shift over the last few months, that the summer has ended and for many it's the beginning of the new normal, kind of?
Sure. So a lot of money is moving into, biotech and healthcare, IT, and distance healthcare. So telehealth and things like that. Also with ed tech, providing those services, certainly in PPE type businesses, anything that's going on with that. But that also presents an enormous opportunity for new companies to come into play. So like building health management systems. And I don't mean healthcare, I mean actual physical real estate property health checks, so that you know that your building has the latest and greatest ventilation system or UV lighting or whatever else, that kind of stuff. So there's going to be a lot of opportunities, a lot of different segments that just haven't become aware yet, right? This is even going to be true for mobility. You know, you could find a new, PPE, personal protection equipment for Ubers or Lyfts or the train or whatever the hell it is. So there's going to be lots of opportunities in a lot of different areas. The interesting thing is we just don't know all the areas yet. What a lot of people misinterpret is they think VCs are investing in trends. We don't invest in trends. We've never done it. We'll never do it. We spot the trends 3 years before the public even knows anything about it, right? And so we just haven't seen all of the things that are going to come out of this. And I'm just talking about, the low-hanging fruit right now.
Yeah, I mean, the other reality is that if you're talking about VC investment, it's heavily weighted towards tech, right? And so the digitization of everything just accelerates trends. It just helps that grow faster. It doesn't really change. There are very few VCs investing in airlines, commercial real estate, like the places that have been hit by this and will probably be hit for a while, movie theaters, restaurants, technically not really heavy VC investment areas over time. So it doesn't really relate.
Not your target though.
Yeah.
So startups need capital, but it's also important that they secure the right investors that will help accelerate their company in an efficient way. So how would you recommend that entrepreneurs identify the right investors for their business?
It's tough. Roy, why don't you start? Go ahead.
Yeah, I mean, look, it is. It depends what the money's for, right? So and there's classic long conversations about sort of dumb money and smart money, and most VCs will tell you that they are, once they're on board, their professional networks will be brought to bear to help you succeed. The reality of the VC world is it's a lot of gambling, right? There's 10% of the investments are going to make a lot of money, hopefully. Maybe 1%, somewhere between 1 and 10% make a lot of money. Another 20 to 30 coast, they do okay. They don't fail, but they don't pop. And then a lot fail. The intention is that, you're taking heavy bets to get big returns on a small portion of the portfolio, right? And, having VCs with expertise in your area or broad networks in your area, that can be extremely valuable. I'd say the proportions are probably about the same as the returns on the portfolio. So 1 to 10% of them add value to you that really matters to your bottom line and your growth. And the rest, it's just money in that helps propel the business forward, on a cash basis.
So I would say Roy is really totally correct from a traditional standpoint. That's how it's really always been. We don't invest that way, so our metrics are the exact opposite of what Roy said. We'll have maybe a 10% failure rate, maybe 20 to 30% of, sort of coasting, and 60% complete outlier 10x plus businesses. Because we invest on a New York banker mentality. That's how I'm trained. No BS, show me the revenue model, let me know what's going on. But we also only invest in companies where we can help you generate revenue. So if we can't help you, we don't invest, right?
At seed stage, do you invest at seed or you invest?
We do late seed, Series A.
Huh.
So again, every VC has their own mindset, so it's different.
Yeah.
But Roy is right in that, maybe 10% of your investors are going to help. Now it depends on the stage that you're at.
Of course.
Cash is oxygen. If you're in an early stage company, get your money in any way you can. If you have the programmers, you have the team, you're developing your product, you don't need any help really yet per se. It'd be nice to have a mentor or two, but really you need cash to pay your programmers. It's really at the Series A that you want to have a lead investor who knows what the hell they're doing, that can guide you, help you generate revenue, but also give you advice on how to run your company. And I don't mean about recruiting and just like how to run a meeting, but I mean about where you should spend your cash, what are the resources you should spend it on in terms of where, like accounting, financial control, sales, whatever, so you're not wasting money, and where you should spend your time. should you be wasting 9 months on an enterprise level contract that will look good from a logo, but really doesn't add anything to your company, right? So you do have to be careful. At the same time, if you have someone that's going to write you a check for half your round under the same terms and conditions that everyone else, and you can get it done and then go back to being heads down and actually working on what you're supposed to, take the money. Like, just take the money.
So yeah, I mean, the only caveat I'd add to that is that we have this term of sophisticated investor for a very good reason. So sometimes dumb money in quotes again, is more expensive than sophisticated investor money, because dumb money, no matter how much of the company they bought, feels that they own the company. And let me tell you, you take money from 20 angels, 5 angels, 50 angels, and they all feel that they own the company and they can pick up the phone and talk to the CEO whenever they want. Holy crap, is that money expensive to you?
So again, Roy is right. You don't want to take you don't want to take painful money.
Painful money, exactly.
So, but the reality is, if you do take money, you have a responsibility as a founder to report. And the best way to keep investors off your back, the best way to avoid those phone calls, is to have a regular monthly report on what is going on, have your cash in the bank on there, have your burn, your expenses, your runway, and what's going on. And that will save you an enormous amount of pain and suffering with your investors. And you should also have asks, right? So,
and you should be clear when you take the money that that's the expectation.
Correct. That's the expectation.
You're going to hear from me. You
and so
cannot call me whenever the hell you want.
Right. Well, the other thing is you'll learn who the investors are. I mean, I call some of my portfolio companies more often than others. It depends. But sure. I also am always trying to help them with stuff. And Roy brings something up additionally, is that sometimes investors think they're owners. That's bad. We don't own a single company. We own nothing of any of our companies. We don't think that way. We are investors in their companies. So we're the adults a lot, but it is their company. We're going to try to steer them and do whatever. And if the proverbial hits the fan, yes, there will be consequences. But we back our founders. We like them. If they misbehave, they get a spanking. That happens. And they come back on board. But they don't work for me.
Have you turned away investing in a company that you thought would be successful, but you did not believe you could lend a skill set or network that would benefit them?
Have we turned down investments because of that?
Yes.
Yes, absolutely. It's happened. I don't want to name too many public names, but yes, it's happened where we have said, I'll name one because it turned out bad. Zenefits. We looked at the company very early on. This was going back 5 or 6 years ago. We're like, we can't help this company. And it just didn't mesh, and we declined. We just declined. And there have been others like that. And then there are others that come to us at the wrong time. We say no. 6 months later, they're a different company, and then they never come back to us for money. And that's okay. That happens too. We've missed a couple of very good ones as a result of that. But we have to stay true to our thesis. And our IRR, we're at almost a 43% IRR for our last fund. That makes us the number 3 or 4 fund for our vintage. Like we're doing well. We're doing fine.
Roy, what do you think?
No, I don't disagree with any of that. And I think I should be limited in Joshua's fund. Like, that's not a bad thing.
Come in, Roy. Glad to have you. That's
a pretty good IRR. I mean, the other thing I would say to startup folks, particularly in the earlier rounds, is that, there's a lot of Silicon Valley mentality that you celebrate funding rounds. Oh, congratulations, you just raised a round, blah, blah, blah. And my worldview, and anyone who's had a liquidity event, you gave away parts of your company for cheap. At the end of the day, you brought money in, sold equity for that, and fundamentally, if you believe in what you're doing and that it's going to be huge, oh my God, we got this great thing, VCs and any investors aren't stupid. They know that they're buying low so they can sell high later, and you have to have the same mentality, right? So you sort of, and I'm constantly advising folks, like, don't take more money, don't take too much money. you should take as much as you need to get to the next material milestone that proves your case better. Every time you prove your case better, every time you show someone known is now known, then your valuation goes up and you can sell less of your company for more money. That's your objective. Sell less for more money. And I know a lot of founders and early people who ended up with not very much of their company because they saw big numbers coming in and they wanted to put cash in the bank, and they sold a lot of their company such that when it finally had any sort of liquidity event, they're like, yeah, man, my 2%, whoo, that was great. Just like, is that really what you want? Or do you want to be Zuck or, guys who hold on to controlling interests of their company? It's a question you got to ask early on, which may seem far off in the future, but it depends how much you believe in what you're doing.
So Roy, it's also very true on all that. The reality is, unfortunately, you do need, when you're going for VC, usually you need the money because you can't get it somewhere else. And we always advise companies to raise at least 18 to 24 months of operational runway. And you should already know who the next VC is. And the problem is, depending on where they are in their fund construction, where they are in deployment, if there's a competitor out there, who you think is going to fund your next round may not be there. And that's where it's important to have someone who understands venture, whether it's a high net worth individual, a super angel, or a real venture capitalist, to be like, hey, Joshua, who do we go to? We're getting ready. You don't do Bs. Who do we go to? And that's when I can work my magic and email 200 Series B firms and be like, hey, guys, take a look at one of my companies. Because every single one of those funds must return my email. They have to. There's no way around it. It might be a no, but they're definitely going to get back to me. Versus getting back to the founder that might email them cold. Then they might be like, I'll get to this in 6 months.
Yeah. The other thing I would say is VC is not the only game in town, right? Like,
Sure.
you can, if you can get a loan on your revenue run rate from your bank and keep your equity and pay back a loan, we all forget that there is a world, and there was a world of independent private businesses that ran, commercial enterprises and got loans and got extensions of credit from their both their suppliers and their customers. Like, there's lots of ways to kind of make sure that there's healthy cash flow through your organization, depending on how fast you're trying to grow and how much cash you need on hand. And I'm not saying that VC is bad, but it's just one of many means of supplementing cash requirements in your business. You sign a big MOU with a massive client or even a contract, have a 1 year or a 5 year contract that shows revenue. You bring that to the bank will forward you some money to make that happen.
Right. So again, Roy brings up a very good point. There are, I would say, more traditional ways. Traditional banks don't do it as much until you're later, but there are places called like lighter capital and venture debt and things like that, which work a very similar way, and they're not, you don't have to sign personally for it, but you have to be generating a certain amount of revenue already, right? And so it is challenging, but it is an excellent way to fund your business, going forward. If you've only taken one round, you don't want to be dilutive. And we have companies that do it, and we actually do encourage it at a certain extent, as long as the companies have the cash flow, because it's actually good for us.
Totally.
We don't get dilution from the next round. But again, founders, what you guys have to be, those of you who are listening to this have to be aware of, is that you may not have that opportunity until you're generating $2-3 million a year. So getting your angel money and your venture money is probably your best bet right now, unless you're borrowing from the bank of mom and dad, which is
the only caveat I'd say to that, Josh,
whole other situation.
The only caveat for me is time frame. So depends how patient your money is and how patient you are, right? So a lot of VCs are investing in tech because they want to return in 5 to 10 years max. They don't want to look at anything beyond that. And the reality is, it depends how patient you are to grow your business. Sometimes it's worth waiting to grow the business and retain more ownership, but sometimes you're in a race. Look, when I joined PayPal, for instance, as a for instance, there were at least a dozen PayPals. Citibank had See To It, Yahoo had PayDirect. I mean, there were a bunch of others, and it was a race. We were all racing to the elbow to see who would hit the inflection point first. And so you wanted to bring money in fast because and so what did we do? We paid for customers. There was a point at PayPal's evolution where you got $10 for signing up for PayPal, and then it went to $5, and then it went to 0. But again, so sometimes you're in a space where it's a race. Okay, I need to sell some equity to make sure that I'm alive, right? But other times, it's not a race. It's not and maybe you should be a little bit more patient with your equity and your ownership stake. It depends on what you're doing.
Sorry, what do you think about bootstrap? So, I mean, would you recommend to bootstrap their companies and do friends and family as long as they can?
I mean, before the 70s, every business was bootstrap. like the model of venture investing and all of that. No, that's not how you started a business, mom and pop shops, and you got money from a bank on a loan or friends and family who supported you to stand up your business. The acceleration of both Silicon Valley and the digitization of the world has changed that model. I mean, so again, bootstrap works perfectly well depending on how patient you are. You're not in a big rush.
Yeah, I agree. Bootstrapping is great as long as your bootstrapping can show that you've actually done something. So you've reached, a minimum viable product and product market fit in your industry, and your bootstrapping has shown that you're doing something so that once you're getting to VC or friends and family, there is really something there. So there's nothing wrong with bootstrapping a startup. In fact, you should be bootstrapping as long as possible.
Exactly.
So that you don't fall into what we call the founder trap, which basically means you end up working for your investors because you've raised so much money and you don't really own the company anymore. Your investors own the company. Exactly. And that's the problem. You don't want to fall into that trap.
And the investors, a smart investor doesn't want that either. They want you to have skin in the game that you care.
So here's the thing. Here's the thing. If you've fallen into that trap, there is a way out. As long as you find the investor that believes in you, it can be fixed.
That's true, yeah.
Your early investors may not love the idea, but they will recognize that you need skin in the game. Yeah. I had a conversation with a founder the other day who told me he only owned less than 25% of his company, and he was going for a seed plus of $3 million. And I said, well, there's a misalignment of interest here. You don't own enough of your company. He's like, well, I don't care. I'm married to a billionaire. I was like, well, then this conversation is going to go nowhere because you're actually not incentivized to put your blood, sweat, and tears into the company because you have something else waiting for you. So which is it? No, I really want to do it. So you've got to be very careful about what you telegraph to the investor because the investor doesn't know you. They don't care about your family situation. They want to know that you're going to put your blood, sweat, and tears into the company and they will write you a check. And I will do that. But I need to make sure that you have enough skin in the game to make it worth your while. Because if you don't, you're out the door. And I didn't invest in your company. That's not what I invest in. I invest in you, your team, your vision, your product, your market. Without you, most of that falls apart.
I would say on the friends and family question also.
Yes.
That can be dangerous it depends how you value your relationship, but you got to be massively transparent, right? Like anyone who's friends and family, if they're really friends and family, then you got to say, if you're not willing to put all that into a bucket and light it on fire, do not give it to me. Because that is the most likely outcome of that bucket of cash. I mean, it just is. It doesn't really matter what business you're in. And so they have to be willing to make that bet going in eyes wide open that you're now investing in a high-risk venture. This is the definition of a high-risk venture.
Basically, don't take money from people that can't afford to lose it.
Exactly.
Okay. Thank you. So I would like to ask your opinion regarding debt versus equity financing. So what are pros and cons for entrepreneurs?
So debt, so it depends on what you mean by debt, because there's various types of debt. So debt from a bank or debt from venture debt.
But yes.
Real debt. That's debt. You sign your name and then they can come after you if it goes bad. Convertible notes are also a form of debt, but it's not personal. It converts into equity of the company, and we're actually fine with it as long as it's structured, the proper way. So depending on the stage of your company, the early investors are going to sign a convertible debt note versus doing what's known as a SAFE. And a SAFE is not a note, it's not equity, it's really almost nothing. It is designed as a warrant structure. The lawyer who designed it, she should be disbarred. It's a terrible structure, it's awful, we don't do it, we don't permit it. It's one of the worst mechanisms you can have. I don't advise on it, and most sophisticated investors don't do it. Some people will do it because they're like, well, they're investing, I want to get in this deal. But basically, if you're doing an East Coast deal, you want preferred equity, definitely not common, we'll get into that in a minute, or convertible note. And you raise based on the concept that you're going to give up, usually at the early stages, between 10, 20, 25% of your company, and then the Series A, 20 to 30% of the company. But always keep it in mind that it's going up. Now, some lawyers will tell you be an LLC. Don't do that. That's bad. You need to be a Delaware C Corp or similar because there are tax implications there. There's also reporting. And we as VCs, we all know Delaware law. All the lawyers know Delaware law. All the counterparties know Delaware law. You want to be a Delaware C Corp. So just,
Yes.
If you're doing an LLC for 6 months, fine. But other than that, you have to switch. You never want to sell common, ever, 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 to an outside investor. Common is used for founders and for employees. And if you sell common, you are essentially violating some aspects of your 409A, which will come back to bite you later. It's not illegal, it's just bad business practice, okay? So don't do that, right?
Thank you. What do you think, Roy?
Yeah, I mean, a lot of I don't disagree with anything, but Joshua's perspective is from the VC side of the table. Like convertible notes can be very valuable to you as a startup founder to push off valuation conversations, right? To not have to agree to because look, at the end of the day, the valuation is how much of your money do you have to give away for that amount of cash? And I think a lot of the reason it was created and the reason people use it is that it pushes off a difficult conversation to be had later with other investors involved.
So I'm gonna push back on Roy on this because that's a common misconception. You are establishing a valuation when you're doing your note. Have no illusions about that, because if there's a cap in your note, so if you raised on a cap on 8 and you've got 2 million, you sold 20% of your business. Conceptually, you may think, well, I haven't really established it, but you have. What you've really done is you've given yourself a lot of maneuvering room.
Yeah.
Because you don't have to raise all at once. You can raise 500, then another 500, then another 500. And you haven't put in all the best practices and responsibilities that will occur under a real preferred shareholders agreement, right? So yes. The valuation, it's not that Roy is wrong. It's just, it's a misperception of.
Well, and it comes down to exactly what he's saying. All the clauses matter.
Right, all the clauses matter. In a note is a 5-page document. And it's kind of wishy-washy, right? It's in there, but you don't need a lead for a note. Like someone might you might do a lead test and say, who can I get in at this? And you don't have to go through the rigmarole of a close and a warranty and all this other crap. Exactly. Which again, I highly recommend. If you are an early stage founder, use a convertible note. Convertible notes are great. They're easy. They're fast. They're relatively painless if you do it correctly. Correct. But please don't stack a bunch of notes on top of each other, right?
Yeah. And look, at the end of the day, all of this is about contracts. You are engaging in multiple contract negotiations over time. And the more complicated you make that with different types of stock and different side agreements and different convertible notes, you're just making a mess that eventually someone's going to need to clean up, So, obviously, the cleaner you can raise money, the better. And the more standardized you can raise money, the better. But, as I said, like there's lots of options. There's lots of options. And understanding what your options are can be, for instance, I think a lot of startups miss the fact that they can get customer financing. That startup is a little company who's dealing with a big company that big company can front you money, and it's nothing to them, and it's everything to you, right? Like, and on the supplier side as well. Like on both sides of your equation, your inputs and your outputs to your business are sources of flow that you can either reduce the outflow or increase the inflow, or a lot of it is timing. Like if I frankly, cash kills more companies than anything else because the timing's off. The money's not coming in fast enough for what needs to go out. And, it's not that there wasn't flow, it's that there was poorly timed flow, and it kills everything. So that's all I'm saying is that there's that the financing part of your business, the raising of funds for your business, it warrants sufficient creativity to look at the range of options that you have to hand.
Thank you. I have the last question regarding crowdfunding because this is relatively new. What do you think about crowdfunding? Do you think that is a good alternative to VC capital?
So again, it depends how much you value your own equity. When you crowdfund, you're not selling equity, you're pre-selling goods generally. I mean, that's generally how most of it.
It depends on the type of crowdfunding platform that you're using, right? So if you're using crowdfunding like Kickstarter or something like that, where you're doing pre-sales, that's great. That's awesome. It's fantastic. We love that. If you're doing crowdfunding like on Crowdcube or Seed Advantage or something like that, we typically as VCs frown upon that. It brings in an additional layer of complexity in the reporting process and your cap table and things like that. We don't love it. We don't like it. It's not awesome. But listen, survive and thrive. Money is oxygen. If you need to do it, do it. Survive. Get it done. If you're an investor, if you're like writing a check into companies, be very careful of crowdfunded companies because you're relying on the diligence of the crowdfunder, which can be very good, but they're also underwriting it like an investment banker and may not be as worried about it as we would be with LPs that are giving us a bigger amount of capital that we have to give back eventually. Because my LPs, they're putting $500,000 up, not $5,000 per deal, right? So it's a very different kind of situation.
And again, it's a sliding scale, right? There's a whole school of thought that kind of began with 500 startups back in the day, where like don't try to be smart, just try to be everywhere, like be diversified, right? So, Dave McClure and the 500 startups guys, and now there's a number of firms. They drop 50, 100, 150 into lots and lots of firms, right? So it's the shotgun versus the high-powered rifle. They're like, yeah, we're just going to, basically that whole school of thought, which crowdfunding kind of falls into that, is I'm not going to be smart. This is a numbers game. It's gambling. I want to bet on everything, and if you bet on everything, you're probably going to win somewhere.
So again, Roy is correct. I mean, YC, 500 startups, Techstars, it's roulette. And YC loves to tout that they have all these great companies. Yeah, well, if you invest in 2,000 companies over 10 years, you're bound to have a hit rate. Their hit rate, sucks. It's actually really bad, like from a statistical standpoint. They have some great companies that have been outliers, that have been awesome, and their growth funds have done well or whatever. Yeah. But if you're in a basic YC, annual batch, whatever, the rate of return on that is pretty weak. It's pretty bad. It sounds good, but it's not good. It's actually it's terrible. It's actually terrible. 500 startups the same way. But what happens is it's giving you optionality. You invest in all these companies, you wait a year, you invest in them again. You wait a year, you invest in them again. So you're putting your real dollars to work, not in this pre-seed or seed, but in the A, and then really in the B, in the C, in the D. And when you have that kind of firepower, that's when you're making real money.
So we have questions from audience. Let me pick it up. They are asking, so I'm in the insurance industry and have a background in tech. I think there is a legitimate use for blockchain technology to be utilized in the transacting of data between agents and the insurance companies, using decentralization to cut out the middleman, IVAN, NC and the agency management system. There is some general interest from a fintech company based on Salesforce as a new agency management system. I'm mostly in the ideation stage. I'm looking for cash to pay programmers I know and a mentor. Where would I go to find this?
I mean, that's a pure friends and family round type situation. You go to the people that know you the best because they're not investing in your idea, they're investing in you.
100%.
And, you know, you need to figure 9 months to 12 months of operational runway. Maybe it's 6 months. I don't know how long it'll take you to build this thing, and figure out whatever you need, 250,000, 300,000, whatever it is. But if you're going out and you're like, I need $1 million to hire 6 guys, you better rethink your business, because that's not where it's at.
Would you like add something, Roy?
No, I mean, so it says background in tech. So are you coding it? I mean, if you're coding it and you need some programmer support to help you get, you know, the MVP, as Joshua says, out the door, I mean, look, then just give some of your equity to a person or those people, you know. So equity, I want to be clear. I said equity is both the most expensive and the cheapest thing you have. It's really easy to give it to someone if you want to, but if you believe in what you're doing, somewhere down the line, you're going to realize you paid them a lot of money, you know, to do what they did. So, you know, that's a trade-off you got to make. If it's never going to get off the ground, then yeah, you know, give 10% of your company to some fellow programmer to get your MVP working, so you have something to show Joshua, and then you can raise some money.
Thank you. The next question is, I have a developer that I paid $10K to develop a website and have worked with us for almost 4 years. He just is not getting the code right, and the website software has a lot of bugs and we cannot use the website and put it out in the market. He often brings up giving him equity and how he feels he has worked with us for a long time and deserves equity. We do not want to give him equity because he is not consistent, and we feel he is holding back our product being out in the beauty market. How would you go about the situation?
So, you know, the $10,000 notwithstanding, that really shouldn't be considered a lot of money, but it is a lot for some people. So I want to be sensitive to that. But the reality is you should cut ties, get rid of the entire site completely, and start from scratch, and find someone who's really going to be either a co-founder, or, because it doesn't sound like this is a technical team, because building a website is no big deal.
Yes.
And if somebody can't get it right, just, you know, go out there and find someone to do it. But you can't have someone holding you hostage. Get rid of them.
And let's be 100% clear. Anyone you give equity to your company to, you are getting in bed with. So if you're not pleased with the work product so far, do you want to continue doing what you're doing? Because equity means that person is not going away. Right. I mean, they might go away if you know, but they own part of your company now. So you're going to be in touch with them.
So again, Roy brings up a great point. Equity is for life. This is not a marriage. Do not think of getting into business with someone is like a marriage. When you are in a marriage, Neil's colleagues will tell you, you can get out. Of course, it happens every day. There's a process. It might take you a long time and it sucks, but you can get out. When someone owns equity in your company, you're not getting out so quick. That's as painful can be, worse than any divorce any of your friends have thought of. So really understand what you're getting into. It's not a quick fix, okay? So be very careful.
Thank you. What are the most common things startups omit in their pitch decks?
Sorry, what most common thing they have in the pitch decks, or they omit financial information, revenues. So we're known for late seed. We are known that we put it out there. You must have a certain amount of revenues in order to get money from us. When I see a deck that doesn't have anything in there and they already say they have traction, I already know there's a problem. Okay. And anyone that says, oh, well, we need an NDA and all this, we don't sign NDAs. Most VCs don't sign them. they're not worth the paper they're printed on, they're useless, and you're already creating a barrier which doesn't need to be there. It's understandable if you don't want to send it around to everybody, but you got to be transparent in what's going on.
So actually, I'm very opinionated on this part. NDA shows a lack of sophistication. At the end of the day, the only way people can help you is if you tell them what you're doing. There are very, very few companies who provide an idea to someone that then gets stolen and they go and do it. It's all about out execution. I mean, execution. I wish that you came up with a novel idea that no other human had, but that is highly unlikely. And Facebook wasn't the first social media network. PayPal wasn't the first payment network. Amazon wasn't the first people selling online. Like, pick a winner. Google, I mean, God, there were like at least half a dozen search engines before Google. It's out execution. So if you don't want to share your idea with people, good luck, but no one can help you then.
And so, again, great point. A lot of founders will be like, this is opportunity. We say at our firm, we don't invest in opportunity. We invest in execution. If you're going to pitch me, what have you done? Not what you're going to do, not your bookings, not this is what's going to happen in 3 quarters. What has happened to lead me to believe that you know what you're doing, right?
The other thing I would say in this omit question, what do they omit?
Yes.
They often omit competition. They don't put in. So look, let me tell you something. If you have a venture that you're starting and there's no competition, so they often say, oh, there's no real competition doing what we're doing. If that's true, you are either crazy or way too early. Those are the only 2 outputs.
Or you're lying. Or ignorant. Like you're ignorant. You just don't know that there's competition. So none of those are good. You either have no idea of who the competition are, or you're way ahead of your time, or you're crazy. What you're doing, no one else is doing. I am constantly advising them, you want healthy competition in your space because it helps 2 things. 1, keep you honest and keep you running hard. You run much faster when you're running alongside someone else who's trying to beat you, A, and B, it proves that there's a market. Like you're not insane, right? Like there's something here. And then C, I would also say in new markets, someone else is paying to educate the market for you. So I would much rather have someone else's marketing dollars explaining what the blockchain is so that I could then out execute them, as an example.
Last question is, what type of equity is typically assigned for a founding team member?
So founding teams always get common equity. There are, for the founders, if it's like 2 founders, 3 founders, 4 founders, they will have founders equity, which is common. And sometimes it has a few additional bells and whistles attached to it because it's founders equity. But if it's a team member, like your first hire, it's common shares. It's always common shares. You might assign them options, which is different, but it's always common shares. And depending on how they're doing it and what they're doing, they need to file an 83B. So if you are even a founder, you should file this, but it's a little different when you're incorporating the company. Because what an 83B does for compensation, it says to the IRS, I was given this equity, which is probably worth nothing, but let's call it $1,000. Let me pay the taxes on it right now, and then you consider it capital gains when I sell it later. Versus you don't file that, you're given the equity 10 years ago, and the IRS is like, that was compensation. We're going to charge you 40% for federal, and in New York, 13% and some other stuff. And California is now going through a 5% equity founder tax or something. And that's bad, right? You always wanted to consider capital gains, especially if you're going to do something that's really big and you want to qualify for small business stock, which is a whole other conversation. But it's common equity. Common equity.
Okay, thank you very much. It looks like we have covered all of our questions. Is there anything else you wanted to cover before I wrap up?
Michelle wants to know your email, Joshua. That's what it says here. How do you like to be contacted by entrepreneurs?
So let's go through that. So generally speaking, and Neil and Tamar can forward my email to anyone who wants it. I don't want
She's
to
asked me for a friend. I take it back.
They can forward it. I'm happy to talk to anyone on this call via an email. So Neil and Tamar, please extend them that courtesy. But generally speaking, the way to meet VCs is, through a number of different ways: through founders, through their LPs, through other VCs, through angels, any way you can. I am reachable. You can reach me. But it's better to reach me through a conduit, because then I'll pay attention. I'll be like, all right, somebody else has looked at this. I'm doing them a favor, so I'm really going to take a look, versus a random email about an education startup for something that I would never invest in, because I may just be like, I'm going to file it away. I'm not really going to respond. I see 5,000 deals a year. I mean, I see a lot of deals. Most of them I kick out of my funnel pretty quickly because I already know what I want to look at. And if you're not hitting what I want to look at, it's gone. I filter it very, very quickly, and I'm very good at it, and my team is very good at it. So if you want that warm intro, find someone that knows me and is like, hey, Joshua, can you take a look at this, please, for me, and tell me what you think? And I'll be like, it's not for us, but if you need, I'll have a chat with the founder as a courtesy. And we do that every day. I personally see 8 to 10 deals a day. It's nuts. I'm a known VC, though. I mean, I've been in this business for years. I'm accessible. And a lot of VCs can do that.
Yeah,
a lot of VCs just may not answer you.
So another secret backdoor, which is worth knowing, might be helpful, is join. If you have a targeted investor that you're looking to contact and you don't have a warm contact and you don't know how to get it, but because Joshua's going to be transparent, here's the things I'm interested in, here's what I'm wanting to invest in, go to LinkedIn and join a group that they are members of as well. That's always free. And through the group, it's one of the secrets of LinkedIn. You can communicate for free with anyone in the same group that you're in. So there's no need to have a premium account or blah, blah, blah. And then through the group, say, hey, I see you're a member of the same group I'm in. I'm in the group because of this, and these are my interests. I'm working on this thing. I thought it might be of interest to you. I mean, you'd be shocked. You can get to pretty much anybody like that.
Great advice, though. We have a last question. How would you approach founders that don't have technical expertise that are launching a tech product?
You need a technical co-founder. I mean, you really do. We invest in teams, right? So if you're investing a tech product and you have no tech expertise and everything is outsourced, that's dangerous. Like, that is a risk that we're not necessarily willing to take. It's one thing if you're a tech-enabled product, which is a little different. Maybe you have a consumer product and you just need a cool website, but you really would want a technical co-founder. Again, however, because we are entering these deals at the late seed Series A, that kind of problem would already have been fixed, right? If you're doing it early, find the technical co-founder or go through an accelerator to help you find a co-founder, or you've paid for the product, but you eventually need someone to own the product, right? And it can't be an outsourced person.
So I think we are about to finish our webinar. I have to say I have learned so much today. This has been a fantastic discussion. I'm sure our audience also enjoyed a lot. Thank you very much for your contribution. And I want to add that if you have any questions, please feel free to email us at info@fridmanlawfirm.com, and also our guest speakers are reachable as well. So thank you very much. Great to speak with you today, and we appreciate you being here. Thanks again for joining us today.
Great.
Thank you very much.
Thank you again. Take care.
Cheers.
Thank you.
Bye.
Bye.